Hello everyone. Today we are learning option chain analysis, what it is, why it's useful, and how to analyze it step by step. What is an option chain? An option chain is simply a table that lists all calls and puts for one expiry. It shows strike prices, last traded price, volume, open interest, and change in open interest. Think of it as the market's X-ray report. Why is it important? Because open interest, or OI, shows where big traders are taking positions. High OI on calls often acts as resistance. High OI on puts often acts as support. By reading this, we understand where the market is likely to stop or move. How to analyze, step by step. Step 1. Pick your instrument like Nifty and select the nearest weekly or monthly expiry. Step 2. Look at total OI on both sides. From this, we calculate PCR, the put-call ratio. If PCR is above 1, puts dominate, support. If below 1, calls dominate, resistance. Step 3. Find the strike with highest call OI. That's strong resistance. Find the strike with highest put OI. That's strong support. These levels become your trading zones. Step 4. Watch the change in OI during the day. If put OI increases, market is building support. If call OI increases, market is building resistance. If OI reduces, it means positions are unwinding. Breakout or breakdown is possible. Step 5. Focus near the at-the-money strike. If put writing is strong and price is holding above VWAP, trend is bullish. If call writing is strong and price is below VWAP, trend is bearish. Quick example. Suppose Nifty is at 20,000. At 20,000, put OI is rising strongly. At 20,200, call OI is the highest. This means support near 20,000 and resistance near 20,200. If price closes above 20,200 with call unwinding, breakout is likely. If price breaks below 20,000 with put unwinding, breakdown is likely. What not to do? Don't trade only on PCR. Don't buy FAR OTM because it looks cheap. Never skip stop loss. OI guides us, but risk management saves us.